This comes from something you said yesterday, and I just want to. I will remind you in a second. But Fed Chairman Jerome Powell announced in June that the Fed would go to press conferences every meeting instead of just quarterly, beginning in 2019. That's already having an impact on the Fed funds futures markets. Take a look here. Look on the left side of your screen here, 4 bars. You can tell on the left side which meetings have press conferences and which don't. The ones with the higher rates. Now look to your right, and it was Becky's remark about the May percentage that caused me to do this.
I still don't remember what I said yesterday.
Well, what you said is, well, it's so high relative to June, and part of the reason was because they're debating, does it happen in May and June, whereas before they wouldn't even have thought about it because it would have to happen in June because that's when a quarterly. You can see now as probabilities now are distributed throughout the months, and that's going to be true as you head further into 2019. So every month now.
And that's actually surprising because the market's instant analysis when we heard from Jay Powell last week was that it sounded more dovish than they had.
That's right.
Going into
That's right. So what all this means for investors, you have to be on your toes for a possible hike at every meeting instead of just quarterly. To be sure, the Fed has always said every meeting is live, but they only raise at the quarterly meetings when they also change their forecast. So they actually condition the market. So in the absence of a clear signal from the chairman about whether a hike is coming, this is going to require greater scrutiny of every Fed speech and interview and every piece of economic data. And that's going to be especially true next year as Fed officials have a wide range of views over where to set rates from 1.9 to 3.625. That's the range for just 2019. You have 8 members above 3% and 7 are below. And there's the trajectory you can see, 2.1, 2.9, 3.4. and 2.9% in the long run. This won't mean higher or lower rates probably, but it could mean more volatility in predicting the Fed, and that could translate into more volatility in broader fixed income and stock markets that investors are going to have to be on their toes about, and traders are going to be probably going to cheer, because when I talked to them yesterday, I said, this will be more volatility. They said, I hope so. Was all the traders said to me.
What other tools could they use? I mean, it's just not only in the front end. I mean, it's also letting bonds run off.
Yeah, I don't think they're going to. I mean, everybody keeps talking about the Fed changing their balance sheet strategy. I don't think they're going to change it. And I remember when I asked, I think it was Powell, it could have been Yellen, I sort of said, well, if the world blows up, are you going to change the balance sheet? And they said, not before we get down to 0 on rates. I don't think they're going to change that mix. They have a strategy on this. I think Powell, what he wants to do is be more transparent, and I think that transparency could possibly pay a price in a little more volatility.